Those three things will really get the stock to get its outperformance legs of old back.
Tesla is a Magnificent Seven's biggest laggard year to date, but it's not the only one. Shares of Apple and Alphabet are also in the red since the start of the year. Now, this week, we are focusing on these three laggards and what it's going to take for the companies to turn things around. Today, the focus is Tesla, currently trading just around $179 a share, a loss of nearly 30% this year alone. Our next guest, though, saying that now could be a good buying opportunity. For more on that and what the catalyst will be, we want to bring in George Generikis. He's with Canaccord Genuity's managing director there. George, it's great to see you. So talk to us about why you think Tesla is a buy at these levels.
Well, first, let's address the reason why it's lagged. I mean, it's pretty simple. The numbers have come down. I mean, if you look at the earnings revisions for the last 12 plus months, they've been terrible. I mean, I think we started for 2023 somewhere early in that year on $6, and it came all the way down to $3. And I think we're at a period of time right now where the worries likely exceed the reality. And we had some numbers last week come out of China that weren't very good, but those people didn't take into account that the new year has been pushed into February. Also, some stuff that happened in Germany. Their plant came down for about a week because of arson, a week plus. And in the U.S., people are worried about the production of their new Model 3. And we think that the best way to kind of gauge, for the most part, what's happening with Tesla, particularly in the U.S., is to look at their prices. And they've been pretty stable in the U.S. over the last few months. So, there's a lot of wood to chop still in the quarter, but in the near term, we think that we may have overcorrected here to the downside.
They talked on their most recent earnings call, George, about the spending and some of the record R&D that they had done during 2023, which now places a lot of emphasis on bringing that to fruition in 2024 and years following now. How much of that spending do you anticipate will lean further towards the side of this artificial intelligence narrative that has started to prevail with Tesla, even though we've seen some early slippage this year, at least in the price action?
Look, we're in a little bit of a pause period right now for the stock. In the near term wiggles, we think we've overcorrected, but for the stock to really get its legs, we have to have three things happen. First, the next generation vehicle has to start to ramp, or people have to gain confidence that it's going to ramp and be successful. Second, their margins need to go up, and the most likely lever for that happening is the increase of FSD, full self-driving penetration, which leverages the AI that they've built, in addition to volumes starting to pick back up. And third, it's continuation in growth, really good growth in their energy storage business. So when you talk about leveraging this R&D that they've spent a lot on, it's two real products that come out of that, the big spending. It's number one, that next generation vehicle, which we think should start production in the second half of 2025, and continued FSD penetration. Now, we think that the FSD offering from the company at $12,000 currently is a little too rich, particularly relative to the cost of the vehicle. We think the company should cut the price of that FSD to really increase penetration and really have the margins start to turn in. If you think about it, that offering is about 100% gross margin, very, very high gross margin because it's a software upgrade.
George, we have seen, though, the price wars play out. Obviously, Tesla, far from the only automaker, one of many, I should say, that has been forced to lower the prices, obviously putting pressures on margins, very similar to what you were just saying. How do you see that, more broadly speaking, beyond Tesla, shaking out just a bit, and that pressure to the downside in terms of boosting demand? How much longer are they going to be forced to slash prices in order to drive the demand that we simply have not seen?
Well, look, there's been a pause, like I said, recently, particularly in the U.S. The price declines that we saw for the most part in 2023 is sort of ebbed right now, which for us is an indication that maybe things aren't that bad. And what the company did strategically by being that aggressive is, first of all, they get to sell more vehicles, right? Because interest rates went up and most people finance the purchase of their vehicles. So that meant that the prices of vehicles went up artificially. But second, it put a lot of their competitors on their back legs. I mean, margins got a lot worse for some of the pure play EV competitors. Sales got a lot worse for them. And even for the traditional OEMs that try to compete against Tesla, their margins got significantly worse because they couldn't compete with Tesla on price. So what we saw is, longer term, what Tesla did is put a lot of its competition on the back foot, particularly in the United States and Europe.
And so let's talk then about China, because that's one of the larger kind of lingering risks right now for Tesla. Is sentiment shifting so much in the region that there would be a longer term implication for how Tesla is able to operate and sell into China as well?
That's a great question. I mean, look, we see the real competition for Tesla long term. Look, we really like Rivian in the United States and in parts of Europe and other parts of North America. But in China specifically, there's some very, very good OEM competitors, some pure play EV companies. The company has one plant in China right now, able to produce about 950,000 vehicles. And they're running, despite this, monthly volatility, they're running full tilt there. And we continue to believe they'll run full tilt in that country. So there's really good competition in China, but we think Tesla can operate that factory at relatively full capacity that leaves them in a good place in that country.
So, George, as we wrap this up, we started this segment talking about the share price being under pressure. We're trading around $179 a share today. What more specifically does that upside look like?
Look, our price target is in the 230s, and we base that on 26 times our 2026 estimates. And we think that's going to happen as volumes start to pick up next year and the year after that, based on increased Cybertruck production and the next generation vehicle. And importantly, we think that the margins will start to get better, particularly as we've seen an abatement in price reductions, at least for now, and costs continue to come down for the company. So, in the near term, we have these wiggles, and we think, like we said, we've overcorrected to the downside in the near term. But, for real outperformance, we need next generation vehicle or some visibility to that, increased margins based on FSD mostly, and continued growth in their energy storage business. Those three things will really get the stock to get its outperformance legs of old back.
Attention, fellow investors. You won't want to miss this incredible opportunity to get in on the potential rebound of one of the biggest names in the electric vehicle industry, Tesla. Despite its recent struggles, with shares plummeting nearly 30% this year alone, there's a glimmer of hope on the horizon. Seasoned analyst George Gianarikas, managing director at Kindergarten Seas, believes that now could be the perfect time to buy into Tesla's stock. Thank you for tuning in to InvestMinder, your go-to source for insightful investment analysis and strategies. If you're new here, don't forget to subscribe and hit that notification bell to stay up to date with our latest videos. Please bear in mind that InvestMinder is not a professional financial advisory service, and our content is intended solely for educational and entertainment purposes. We strongly recommend consulting with licensed professionals before making any investment decisions. Now, let's dive into the compelling case for why Tesla's stock could be poised for a turnaround, and what key factors need to fall into place for this to happen. According to George Gianarikas, there are three critical components that must come together for Tesla to regain its momentum and drive its stock price higher. Firstly, the company's highly anticipated next-generation vehicle needs to start ramping up production, or at the very least, instill confidence in investors that its launch and success are imminent. Tesla has poured significant resources into research and development, setting new records in 2023. However, this substantial investment will only bear fruit if the company can translate it into tangible products that captivate the market. The next-generation vehicle is undoubtedly the centerpiece of Tesla's future plans, and its successful rollout could reignite investor enthusiasm. Secondly, Tesla's margins must improve, and Gianarikas believes the key to achieving this lies in the increased adoption of the company's full self-driving FSD technology. This cutting-edge artificial intelligence system, which Tesla has invested heavily in developing, has the potential to significantly boost margins as more customers opt for the software upgrade. Currently priced at a hefty $12,000, Gianarikas suggests that Tesla should consider reducing the cost of the FSD package to make it more accessible and drive higher adoption rates. With FSD essentially being a software update, its profit margins are incredibly high, making it a potential goldmine for Tesla if they can entice more customers to embrace the technology. The third factor crucial to Tesla's resurgence is continued growth in its energy storage business. While the company is primarily known for its electric vehicles, its energy storage solutions have been gaining traction and could become a significant revenue stream in the years to come. Gianarikas believes that if these three conditions are met, the successful launch of the next-generation vehicle, increased FSD penetration driven by a more attractive pricing strategy, and sustained growth in the energy storage segment, Tesla's stock could regain its former glory and outperform once again. However, it's important to note that Tesla's road to recovery is not without obstacles. While Tesla currently operates a massive production facility in the country capable of churning out nearly 950,000 vehicles annually, it faces stiff competition from domestic pure-play EV manufacturers. Gianrikas acknowledges the formidable rivals Tesla faces in China, but remains confident that the company can maintain its dominance and operate its Chinese factory at relatively full capacity. Nevertheless, investors should closely monitor the competitive landscape and Tesla's ability to maintain its edge in this crucial market. Another factor that could significantly impact Tesla's fortunes is the ongoing price war in the automotive industry. As interest rates soared, the costs of financing vehicle purchases skyrocketed, forcing automakers to slash prices to maintain demand. Tesla was at the forefront of this price-cutting frenzy, aggressively reducing the sticker prices of its vehicles. While this strategy undoubtedly put pressure on Tesla's margins in the short term, Gianrikas believes it was a strategic move that could pay dividends in the long run. By offering more affordable pricing, Tesla not only boosted its own sales volumes but also dealt a severe blow to its competitors, both pure-play electric vehicle manufacturers and traditional automakers alike. Many of Tesla's rivals found themselves struggling to match the company's price cuts, leading to a significant erosion of their margins and sales figures. This aggressive pricing strategy has effectively put Tesla's competition on the back foot, particularly in the crucial US and European markets. However, as Gianrikas astutely points out, the price war may not be over just yet. The pressure to continue slashing prices to drive demand could persist, at least until economic conditions stabilize and interest rates retreat from their current elevated levels. Investors should closely monitor how Tesla navigates this challenging environment and whether the company can maintain its pricing power without compromising its profitability excessively. Another potential risk factor for Tesla is the potential shift in consumer sentiment, particularly in China. As one of the company's largest and most critical markets, any significant change in perception or regulatory landscape could have far-reaching implications for Tesla's operations and sales in the region. While Gianrikas remains optimistic about Tesla's prospects in China, citing the company's ability to operate its massive factory there at near full capacity, investors should remain vigilant and closely monitor any developments that could impact the company's standing in this crucial market. Despite these challenges, Gianrikas maintains a bullish outlook on Tesla's stock, with a price target in the $230 range. This projection is based on a multiple of 26 times the company's estimated 2026 earnings, reflecting the expectation of a resurgence in sales volumes driven by increased Cybertruck production and the successful launch of the next-generation vehicle. Moreover, Gianrikas anticipates that Tesla's margins will improve as cost-cutting measures take effect, and the company potentially reduces the price of its FSD offering to drive higher adoption rates. This, combined with continued growth in the energy storage business, could provide the catalyst needed for Tesla to reclaim its status as a market leader and regain investor confidence. While Tesla's recent performance has been lackluster, with disappointing earnings revisions over the past year contributing to the stock's substantial decline, there are reasons to believe that the company's fortunes may be poised for a turnaround. Gianrikas suggests that the market's concerns may have been overblown, and that the current share price could present an attractive buying opportunity for investors willing to take a long-term perspective. One of the key factors that have weighed on Tesla's stock is the underwhelming production figures from some of the company's major facilities. For instance, recent data from China failed to account for the impact of the Lunar New Year celebrations, which were pushed back to February this year. Similarly, Tesla's German plant experienced a temporary shutdown due to an arson incident, further disrupting output. In the United States, concerns over the production ramp-up of the Model 3 have also contributed to investor jitters. However, Gianrikas suggests that a more reliable indicator of Tesla's performance in the domestic market may be the stability of its pricing strategy. Despite the challenges, the company has managed to maintain relatively steady pricing in the US over the past few months, potentially signaling a more resilient demand environment than some analysts had anticipated. While acknowledging the difficulties Tesla has faced in recent quarters, Gianrikas remains optimistic about the company's prospects, citing the potential for a near-term overcorrection in the stock price. As the market digests the latest developments and adjusts its expectations, there could be an opportunity for savvy investors to capitalize on any irrational selling pressure. Alongside the potential for a stock rebound, Tesla's ambitious plans for the future could also contribute to its resurgence. The company's ongoing investments in research and development, while weighing on short-term profitability, are laying the groundwork for groundbreaking innovations that could reshape the automotive industry. One area where Tesla's R&D efforts could pay significant dividends is in the realm of artificial intelligence, AI. The company's full self-driving FSD technology, which leverages advanced AI algorithms, has the potential to revolutionize the driving experience and provide a substantial competitive advantage over rivals. As the adoption of FSD increases, driven by potential price reductions and improved accessibility, Tesla could see a significant boost to its margins. Since FSD is essentially a software upgrade, the associated profit margins are remarkably high, making it a potential goldmine for the company if it can entice a larger portion of its customer base to embrace the technology. Furthermore, Tesla's commitment to pushing the boundaries of innovation extends beyond just its electric vehicles. The company's energy storage solutions, while often overshadowed by its automotive endeavors, could emerge as a major growth driver in the years to come. As the world transitions towards renewable energy sources, the demand for efficient and reliable energy storage systems is likely to surge, presenting Tesla with a lucrative opportunity to capitalize on this burgeoning market. While Tesla undoubtedly faces a multitude of challenges, from intensifying competition to the ongoing pricing pressures, the company's long-term prospects remain promising. Gianarikas believes that if Tesla can successfully execute on its ambitious plans, the stock could regain its former glory and deliver substantial returns for patient investors. One of the key catalysts that could propel Tesla's stock higher is the much-anticipated launch of the company's next-generation vehicle. This highly anticipated model is expected to showcase Tesla's cutting-edge technological prowess and could potentially redefine the standards for electric vehicles. By offering a compelling blend of innovation, performance, and sustainability, the next-generation vehicle could reignite consumer enthusiasm and drive a surge in demand. Moreover, the successful rollout of this new model could instill renewed confidence in Tesla's ability to deliver on its promises, potentially reversing the negative sentiment that has plagued the stock in recent months. If the company can demonstrate its capacity to execute flawlessly on this critical product launch, it could pave the way for a broader reappraisal of Tesla's long-term prospects by investors. Another factor that could contribute to Tesla's resurgence is the potential for increased adoption of its full self-driving FSD technology. As more consumers embrace the convenience and safety benefits offered by this cutting-edge AI system, Tesla's margins could receive a substantial boost. Gianarikas suggests that by making the FSD package more affordable, the company could incentivize a broader segment of its customer base to opt for the upgrade, unlocking a lucrative revenue stream with remarkably high profit margins. Furthermore, Tesla's commitment to innovation extends beyond just its automotive offerings. The company's energy storage solutions, which have been steadily gaining traction, could emerge as a significant growth driver in the years to come. As the world transitions towards renewable energy sources, the demand for efficient and reliable energy storage systems is likely to surge, presenting Tesla with a lucrative opportunity to capitalize on this burgeoning market. While the road ahead is undoubtedly lined with challenges, Gianarikas remains optimistic about Tesla's ability to navigate these obstacles and emerge stronger than ever. The company's unwavering dedication to pushing the boundaries of innovation, combined with its willingness to adapt to changing market conditions, could ultimately be the key to its long-term success. Investors who can look beyond the short-term volatility and maintain a long-term perspective may find that the current pullback in Tesla's stock presents an attractive entry point. As the company executes on its ambitious plans and delivers on its promises, the potential for significant upside could materialize, rewarding those who had the foresight and conviction to invest during these turbulent times. As we approach the conclusion of our analysis, it's evident that Tesla's road to recovery is paved with both challenges and opportunities. While the company has faced significant headwinds in recent times, the potential for a turnaround remains within reach, provided that certain key factors align. The successful launch of Tesla's next-generation vehicle, coupled with increased adoption of its cutting-edge full self-driving technology and sustained growth in its energy storage business, could catalyze a resurgence in investor confidence and drive the stock price higher. However, it's crucial to acknowledge that this path is not without obstacles. Intense competition, particularly in crucial markets like China, ongoing pricing pressures, and potential shifts in consumer sentiment, all pose risks that investors must carefully navigate. Ultimately, the decision to invest in Tesla's stock will depend on an individual's risk tolerance, investment horizon, and confidence in the company's ability to execute its ambitious plans. For those willing to embrace the volatility and maintain a long-term perspective, the current share price could present an attractive entry point, offering the potential for substantial returns if Tesla can deliver on its promises. As we bid farewell, we encourage you to conduct your own thorough research, consult with licensed professionals, and make informed decisions that align with your investment goals and risk appetite. Remember, the journey to financial success is often paved with challenges, but those who possess the courage to navigate these obstacles with conviction and foresight may find themselves rewarded in the long run. Thank you for joining us on InvestMinder. We appreciate your continued support and look forward to embarking on many more thought-provoking investment discussions in the future. Until next time, stay informed, stay curious, and happy investing.
Hope you found today's analysis helpful as you look for profitable new stock opportunities. This was InvestMinder. Remember, knowledge equals profit in the stock market. Thanks so much for watching, and please hit that thumbs up button if you got value from this video. Make sure you click to subscribe as well to get our next videos when we reveal the best new insider stock purchases. Invest wisely, trade carefully, and we'll see you next time. Disclaimer: InvestMinder is an independent stock market commentary channel for entertainment and basic informational purposes only. We are not licensed financial professionals and do not provide personalized investing or financial advice. P.S. If you stayed watching until here, you are awesome. Thank you for enabling me to keep making these videos with all the likes and subscribes. Have a great day, and we love you all.